Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everybody. Welcome back to Carson's Facts versus Feelings. Ryan and Sonu, as always. Sonu, we have a very, very special guest. You guys are saying you guys talk pretty much all the time, so I know I'll let you do the intro here, but we're pumped about having Skanda back. But take it away from here.
Yeah, talk or at least chat via, Twitter, direct messages, and, somebody whose research I read all the time.
Yeah.
As soon as the emails come, I'm always opening it. Skanda Amarnath from Employ America. I'll let Skanda give his official title since we like doing that here. But welcome, Skanda. Welcome back. We've had you before. We did the Halloween episode. Last time we were all dressed up.
With Neil. That's right.
Yes. Yeah. Yes. And I'm thinking back to Neil's outfit, but
yeah, that feels like ages ago. So I'm Skanda Amarnath. Thank you for having me on again. I'm the executive director at Employ America, which is a macroeconomic policy research organization.
No, it's fun. I guess this is the second time, right? This is not the third time, but was that? Do you remember? I think so. Like Sonu said. Like Sonu said, we read your stuff. We're obviously big fans, so we feel like we know each other. But just to get to the nitty gritty, episode 136 of Carson's Facts versus Feeling here, talking about everything with Skanda. So there's lots to talk about. Skanda, maybe let's dig in just a little more for the listeners. I know you kind of talked about what you do, but dig in a little bit more. Like, what do you and Employ America do all day to help investors? And just always think about, there's a lot of financial advisors that listen to this particular podcast. How could you help some financial advisors as well? Then we'll get into it a little bit.
Yeah. And I'll just add to that, and just to, because you guys got to 2022, 2023 even, and 2024 right with respect to inflation, how to think about inflation, what may be coming as inflation. I mean, every time I look at all the sell side forecasts for, what CPI is going to do, what PCE is going to do, and you can talk about this as to why your forecasts seem to nail it, whereas all these guys at these sell side shops are not accounting for whatever it is they're supposed to account for. So I'll let you go.
Well, I appreciate that phrase. I'll say what we tend to do starts from the notion of eat your vegetables with macro data. So there's just a lot of macro data out there, and start with the data before you start to tell the story. We can all tell stories after we first are on the same page on the data. And a lot of what we do is really about the blocking and tackling of understanding each data release, the guts of it. So every single data release has different CPI components and different payroll sectors and different age groups that are employed and unemployed. And there are different segments of retail sales and different segments of housing starts. And that all is very useful information for being able to tell, this is the story that actually checks out. And this is the one that's just for shock jocks. And macro is full of shock jocks, and we really try not to be that. We'll change our minds when we need to change our minds. Sometimes we'll be a little late. We'll try to be as early as we can without being super volatile in our views. And I think we just try to be good faith readers of what's going on in terms of the actual information set, which is there's a lot of macro data to parse, and it's not easy to parse it well. It's not something you can plug into a machine to figure out for you. You have to kind of do some causal thinking. You have to actually say, does A cause B, or is A just correlated to B? And we try to do a lot of that kind of work in a pretty detail-oriented manner. I think the people who follow our work have felt like they have a better handle on inflation, both in terms of the bigger picture, as well as, look, the Fed follows PCE, not CPI. And there's a lot of things to walk through in every given month just to kind of walk through that. So if you're trying to anticipate Fed policy, if you're trying to understand why, hey, inflation's at 3%, why did the Fed do X instead of Y? It's well, there might be some answers in between there. And you might have been a little bit ahead of the curve if you kind of looked at some other information on some key interest rate decisions, 2023, 24, and probably 25 too. So I think it just pays to pay attention.
Can I ask one quick question? I was going to go general way, but since you mentioned inflation, if you had to pick an inflation measure to follow, to reflect as much as possible what's happening on the ground with respect to inflation, would you pick CPI or would you pick PCE? Or, I'm assuming you're not going to pick all those, crazy private measures that some of which, or M2 or something like. No, I'm only kidding. PCE or CPI?
The diplomatic answer is for what purpose, right?
Sure.
If you're thinking about this from a CPI tends to be more volatile than PCE, which might be a reason to say don't pick CPI. But actually, if you're trying to track what's going to happen in the, call it, investor universe, right, then it actually has a little bit more of the momentum or the juice of saying, like, okay, this is where CPI is trending this way. The people who care about PCE is the Fed, and that does matter to interest rates, and that obviously affects asset prices. But if you think about like what really drives like macro narrative, I would say CPI tends to be where people because it comes out earlier, it's simpler in a lot of ways. People just latch onto it, right? There's no like issue of like, oh, the CPI data is revised. It's not like, none of that's the case. Once you see on CPI days what you get, and so that's very valuable if you're someone who's just trying to follow stuff with a relatively narrow, like limited attention span because there's so many other things going on. So I have a lot of sympathy for CPI in that sense. Conceptually, if you're trying to measure sort of standard of living over long periods of time, PCE is better. There are a lot of reasons why CPE is better. But if you're just trying to get a sense for like, here's where the puck is going, like that CPI can kind of be a better proxy.
So speaking of where the puck is going, we'll get more into the weeds of it. But just this year, I mean, obviously listeners of our podcast know how just, I don't know, unique, maybe the word I'll use, on April 9th, I think Goldman said recession, and then like an hour or two later, who was it? So someone came out and said recession. An hour or two later, they said, "Our bad, never mind." Was it Goldman? I forget.
It was Goldman. Yeah.
So
I'm talking about it. I really like Goldman.
Whoa, we're big fans. I mean, I want to be clear, we're big fans, but that's how difficult this year's been. And it's like, okay, never mind. And then 50% chance recession, 35, and it's going all over. Everybody gives their percentages, and we want to get into that with you. But just from a bigger picture point of view, how difficult has it been to do macro, to do the stuff we're talking about the economy, when truly one tweet can kind of blow up your whole thesis? How's it going for you?
I will say there are a lot of moments where like, I wish I could crank out this note really quickly, and then 20 minutes later, I'm like, oh, I'm really glad I did not crank out that.
Yes.
And so that challenge, I think a lot of analysts are facing right now. And I mean, I think the more notorious one to me is when someone comes into the year saying 0% chance of recession, then boost it up to 90%. And then it's back to 30%.
Somebody did that? Oh,
I'm not names. No, it's okay. We won't pick on it.
It's not that hard to find, but I do think it's an example of where probabilities, just like, I think because we're in a more volatile environment, the risk, the probability associated with typical tail risk is higher. But you can't move this stuff around too much, otherwise it doesn't mean anything. And so that is the other part of it, where you can't just say, oh, it's a certainty now it's an uncertainty. It's like, the world is probably closer to what feels like coin flips in that sense. Not fantastic from being able to have a view and really express it clearly. I've also done a version of flip flops. I'd say I think my views have kind of shifted pretty sharply in the last 6 weeks, and some of it was probably early and some of it was late. And I think that's just like, kind of have to accept that there is some level of tracking error there that you have to just be accountable for. The worst thing to do is to be stubborn and say, I know this is going to happen, and then like try to find ways to prop up that view even as things change.
Functionally, what is the difference between a 35% probability of a recession and a 65% probability of a recession?
Functionally, in terms of financial markets?
Yeah. And like, for those of us trying to like, okay, what do we do with that information?
So, I mean, if you think about, to me, what's useful about some of this stuff, and I agree, it's probably
Because I picked those numbers because it's close enough to a coin flip. That's why I picked those 35 and 65.
35 and 65. The way I think what's useful about it is the pricing of particular assets, right? Where you think about how rate cuts, how much did you price into 2025, 26?
Sure.
Right? If we're dealing with a recession, it should matter. And likewise, like if you're thinking about like in general, stock markets don't really gravitate around some valuation anchor, right?
Mm-hmm.
But they do have a sort of regime switching quality to them when you do enter a recession. Multiples typically do contract. Earnings estimates obviously have to go down. And so that tends to lead to repricing pretty consistently, right? And each recession is different. Some are bigger drawdowns, some are smaller, some are longer, some are shorter. But that is like why we care about this. And you kind of have to care upfront rather than just say like, oh, I'll wait till the NBER calls it a recession.
Right. No, absolutely.
So that's the reason for doing it. And then the question of like, what's your confidence about 35 versus 65 is kind of should be anchored around that, right? Like what was, and now I will say it's highly discretionary, right? Even if you say I have a recession model, right?
Yep.
Oh, I said the yield curve inverted, therefore X, like those are they kind of work and then they kind of don't, right? Which is to say, like, they work
indicator macro. Yeah.
It's a lot of indicator macro and it has a lot of problems because you don't understand why that correlation existed, why it didn't quite exist subsequently. And I think that's like a big, like so in the end, it's art. It's not artful, but it's more art than science. And I think that's like a way of saying this is probably where, this is a set of scenarios that feel more likely than not. And I think it's probably good to not go beyond a certain set of increments for changing your recession probabilities, but it's just a way of saying, yeah.
So let's kind of dive in there. We'll start. I mean, I don't know if you do percentages, but what do you think of the economy now? And with the change in April, okay, now we're going to do 90-day pauses and you get 10%, you get 10%, you get 10%. Where is the economy right now, Skanda?
No, he said next week he's going to change it. Today,
I know.
Well, came out and said he's going to fix some tariff rates because we don't have the bandwidth to negotiate with everybody.
And I want to point this out. We are recording this actually on Friday, May 16th. So we know this doesn't come out to the following Wednesday. So everything we say, who knows what it's going to mean. But let's just assume the world is on Friday, May 16th, Skanda. From an economic point of view, how do you see things?
I think that we came into this year with decent momentum. Like the U.S. economy was like, in some broader sense, slowing, but not in any alarming sense. And we had some benefits of rate cuts in Q4 that were starting to kind of peek through. Non-farm payroll growth averaging over the last 3 to 6 months, something like 150 to 200K a month. That is very respectable, right? Now, we can parse through the cracks of like, hey, it's coming from these sectors, and that's not typically the case. And we can grumble, but like that's still 150 to 200,000 jobs a month is a lot, and especially when you think about where we are in terms of employment has broadly recovered from the pandemic recession. We're not coming from a low base here. We think about like GDP growth. Last year was quite good. It was the high twos. For real GDP growth, productivity growth was quite good. So we had a lot of momentum. And then, like, think about balance sheets. Balance sheets in general, it's not one-to-one, but the fact that we've been running, the deficits have been large in some sense on the public sector side has also meant, like, that there's also very supportive conditions for private sector balance sheets, right? So that's free cash flow that's going elsewhere. If there's governments leaking free cash flow, then the free cash flow is kind of emerging in the other side of the ledger. And that's really true for corporates and households. I think it may probably more so for households than for corporates. But it's not as if like they can't absorb a shock that's kind of what we've been hit with. The question is like how long? Eventually there's a limit to how much private sector can absorb. But at least all things considered, this was not the kind of private sector balance sheets of either 2006-07 or even the year 2000, right? I think that's probably like still very meaningfully different. And so those things were quite good, and inflation was declining. I think you could say inflation was on the decline. The components that were still contributing to the inflation overshoot were largely speaking components that were lagging and were primed to slow down this year. And they are slowing down right now. So all those things, we kind of had good initial conditions. I think that part, was true, and we've now been hit with the shock in terms of just like policy uncertainty. There's a lot of supply chains that are likely to be bullwhipped by this sort of like wax on, wax off approach to tariffs. But it's probably not the kind of thing at this point that's showing signs of tipping over or setting off really adverse feedback loops, at least not yet. And so I kind of come at this as, at one point, it seemed like we were in a policy trajectory that suggested recession, but it would have to require one set of dominoes to tip over a new set of dominoes. I think that the odds are that's at least been pushed out. Those scenarios are not something that I would think of as being as imminent as I feared, call it 4 weeks ago.
Okay.
Should we have expected two things? I think sentiment was so poor in whether it's related to the markets, related to the economy, all of it. It's tied together, obviously. But early April, people were like, oh, maybe April payrolls will fall off a cliff. Maybe April inflation will jump really high. Yes, the tariffs have been paused, but even when we got April payrolls data, that was before the recent China pause, right? And payrolls didn't collapse. Like you said, last 3 months, yes, these things can get revised and things like that. Last 3 months, about 150, 160,000 jobs, something like that. It didn't fall off a cliff. I know you follow the prime age employment population ratio. That's at 80.7%. Very reasonable, pretty good as these things go, I imagine. So where are you with respect to the data? Is this like the calm before the storm, especially for inflation, right? Yeah. Should we expect inflation to pick up when we get May, June, July numbers?
So my revision of my views is primarily about the policy trajectory and the financial market sort of like interpretations of it, right? That those two things have kind of moved. The policies have moved, and the financial markets are kind of like are obviously trying to front run some of these dynamics. Quite correctly, it seems like to me. So you kind of have to respect that dynamic. I don't think it's about the data for me. Why I would be more optimistic now than 4 weeks ago. Just because it takes time for these dynamics that we know about in real time. We read the news, we read the Walmart earnings call, we read all these things that we can get a grip on, but they're not things that show up instantaneously in the macro data. It takes a little bit of time. So I had one of the softer forecasts for CPI this past week.
Right.
I'm going to pat myself on the back.
And we'll do the same too.
Because it just takes time to do this. It takes time to like have firms don't just instantaneously adjust prices the moment they saw the easel that President Trump rolled out on Liberation Day. Like, it doesn't work like that. There is some inertia. There's some stickiness. You wait and see, are these policies going to be in place? Are they negotiating deals? Are they going to do a pause? You got to give some room. Now, I do think that the odds of inflation showing more strength in the summer the odds are pretty high to me that we're going to see some firmness. We can already see it in some components like used cars. The auto market is likely to tighten up quite a bit. We'll see about some of the other supply chains. I suspect because we've now done sort of like a big relief on China tariffs, that will also have some impact for the freight market. So we'll probably see a pickup in freight activity. So we'll probably see like a surge in activity and something that kind of has an echo or something that reminds us a little bit of the pandemic era bullwhips.
That's the wax on, wax off bullwhip thing. We didn't have any imports, or, metaphorically sort of speaking, and suddenly everyone's looking to build order books again.
Yeah, and I think that seems like it's like there's clearly some things also that kind of dovetail with some of the tax bill changes that may be coming up that could also have some of those impacts. And so because of all of that together, you're left with a pickup in activity that might strain prices in Q3 probably, or at least sometime around the summer, I would say. So I still think that's the case. On employment, I'm more willing to just revise my views and just say, I think if you were worried about loss of employment in a lot of the logistics industries that are kind of tied to trade, you don't have to worry about that right now. If you're worried about manufacturing jobs kind of being cut more aggressively, again, we're kind of in this holding pattern, and I don't think that probably means we're not likely to see the same scale of shock. And so the labor market probably can stay afloat for a lot longer if that's the case. If financial markets show more panic, obviously I would have to think twice about that claim, but I don't think we're seeing that right now. And I also do think the policy structure is now one where manufacturers are probably also inclined to wait and see. And so these things are all kind of simultaneously causal. They all A causes B and B causes A. So you kind of have to watch all of it together. I don't think that I think the labor market's probably in better shape, but I don't think by better shape it probably means we're not going to go through 100,000 on job growth right now, at least.
Got it.
This is, again, episode 136 of Carson's Facts versus Feelings. Amazing. We've hit about the halfway point. It's amazing how fast things go. Talking about everything with Skanda. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. Facts versus Feelings, VS at carsongroup.com is our email. Skanda, you said a word earlier that struck me, the word productivity. A couple of years ago, you guys were in the camp that we were going to see a pretty big surge in productivity in the United States. I know Sonu's been talking about this also. Clearly, it's happened. One thing that always struck me was years that have really strong productivity tend to have much better economic growth than what was forecast, and the stock market tends to do pretty darn well also. Back-to-back 20% years, I don't think it's a coincidence because we had strong productivity, and you were one of the very few people to look for that the last couple of years. We just had a productivity number, I guess it was last week. Well, the time people listen to this, well, because I'm trying to do the math, it was technically 2 weeks ago when the people listen to this. You know what I'm saying. Recently, we had a productivity number. Wasn't that great? Can you talk to me about productivity as it pertains to everything going on with trade? Is the productivity trade done, or where does that stand?
Yeah, is that story over?
Yeah, that's
the 90s boom.
Yeah,
because you guys wrote a series of really good pieces. Yep. And I'll be honest, I piggybacked off of your research when I talked about productivity.
Yep.
I think that it's at least contingent on policy, and I do think Q1 you saw some of the effects of firms front-running tariffs, and so they're taking on more cost and pushing up price in ways that tend to throttle overall output. Obviously, you may do more logistics and trade activity just to front run these processes, but it's actually not helpful in terms of overall output growth. And so we generally see I think if productivity's got three-legged stool to it, right? You need to have a trained and experienced workforce, right? So obviously that's if you're kind of coming out of recession, this is generally not a great time for productivity growth just yet. You need to have costs under control, right? You need to have some level of not being faced with oil price shocks, commodity price shocks, supply chain snarls, that kind of thing. The trade uncertainty has several whiffs of that. And then also investment, right? So what exactly happens to business fixed investment, and especially if investment's going to grow in a way that's scalable. So that, I think that latter part is not we saw business fixed investment was quite strong in Q1. That had probably some component of tariff front running. I do worry about business fixed investment over the next year. There are some things that may offset it though, and so say the tax bill, if they do some fairly aggressive measures that are at least being proposed right now. Fixed investment might be the best case for being pro productivity growth, but I do think a lot of the trade policy uncertainty is very obviously unhelpful. It leads to higher costs. It sort of slows down investment. And I think, especially if all this stuff is being done primarily by executive order, I'm not sure how many businesses are going to look at that and think, okay, that's going to stick for a long period of time. Or not executive order, but through some unilateral administrative action. Is not, and especially if that action can be reversed on a dime, it doesn't breed a high level of confidence.
On the investment, I feel like if not for all of this stuff, we'd be talking about the AI story and how the AI story is showing up in the macro data, GDP data. You've talked about it with our team, electrical equipment production, right? We talk manufacturing facilities and how those factories have to be populated with equipment now, and so equipment production needs to ramp up. And I feel like that's all what we would normally be talking about. And you mentioned business fixed investment was really strong in Q1. Big part of that was IT spending and software spending too. And it feels but there was so much noise around it, and we just couldn't focus on stuff like that. Is that what we've lost?
I mean, I think if we weren't talking about the trade policy uncertainty dynamics so much, I think we would be talking a lot more about tech. I think that's if you actually looked at the Q1 data on the demand side, generally speaking, to a first approximation, that does tend to be the volatile component that drives GDP. And a nice fancy way of saying spending really matters. And there was a ton of spending on the AI adjacent segments, I'd say. So you see IT equipment, hardware, software, a lot of the energy infrastructure that's used for powering the data centers. You can see that, like turbines and generators. All these things are also, there's a heavy dose of spending in Q1. And because of that, if you just took that contribution to GDP growth, it would be like 1.25%. Now, obviously, that negative number in Q1. 1.25% is quite a bit, especially if relative to like trend GDP growth of 2%, roughly speaking, 2.5. Maybe we're doing like something closer to 3 in the last couple of years, but it's still not like it's still a very meaningful contribution. And if we see that some sustain over the next couple of quarters, obviously it's good for productivity growth over that period of time, all else equal. Obviously, you need to be able to supply to meet that demand. But the other side of the coin is like that's a place where it has echoes of certain tech euphoria of past periods, where you're driving GDP growth in such a big, meaningful way to the upside. You certainly don't want to have a big downswing in those areas. I don't foresee an instantaneous downswing right now, but it's something to watch for in the next couple of years, I'd say, to say, hey, like if there's a risk to the tech sector, it will have macro implications both through the equity market and through sort of a lot of the GDP components that matter. But for right now, I'd say I'm not expecting that, at least imminently.
It seems like what you're saying is like, there's so much noise now, but setting that aside, as one sector of the economy, in this case tech, and maybe what happened in the 90s, starts to contribute more and more to GDP, then there's a risk that the moment that stops happening, things fall off pretty quickly.
It's a risk to watch out for. I think at this point, it's a tailwind. It's a tailwind for growth, and probably a tailwind for productivity growth. So these are things that it's worthwhile. This year, the case I came into this year with, everyone is saying GDP growth is going to be bad because of X, Y, and Z, and I think those reasons are still mostly operative. But I do think people would dismiss the AI capex dynamic, which is very real in terms of if you look at all the big corporates and the big the Mag 7, like what they're actually spending.
Sure.
And you're starting to see in the GDP data. It's been swamped by Q1. I'd say was largely swamped by a lot of trade dynamics. We'll see how that plays out.
Well, the good news. Next week on the Facts vs. Feelings podcast, we have Dan Ives joining us. And if you listen to this on May 21st, when this particular podcast came out, Sonu and I will be live in Omaha on stage with Dan Ives. So there's probably no one in the world better to ask some of these AI questions. So we'll get to the bottom of it with Dan next week as well. You know, Sonu came up with a couple of questions. I came up with a couple of questions. I'm going to steal ones that Sonu had here because I think this is interesting. Yeah, well, I like this one. So this is a good one. Skanda, you hear about tariffs. Someone has to pay the cost. So who really pays the cost of tariffs? Is it consumers, businesses, exporters, somebody else, a combination? I mean, who really pays the cost of tariffs?
And I'll tag, how would we know that?
There you go. Okay.
It's usually a combination of the business that's importing the product, the final consumer who's actually the one who pays a decent chunk of it. When do costs get pushed through is really what we're talking about here, right? And I think this, just because even if we have a weaker labor market or a weaker economy, I think there's a sense of, okay, that means like they'll just eat the cost of the business and it won't show up to the consumer. And I will warn, if you look back at a lot of other periods where we've had big price shocks, this is not quite true. Which is to say, like in 2008, you didn't just see oil prices rise. You saw the price of jet fuel rise, and it did push up airfare inflation. Some of the strongest periods of airfare inflation coincided with one of the worst labor markets and worst economies in history. So costs are something that have to be pushed through at some point, or else the business shuts down, right? Because if it's eating too much into margin. Do these tariffs qualify as that? And I think that's a question of how big are the tariffs, right? And we don't really know. And maybe they'll give you a different answer when this podcast comes out. It could be, if it's 10%, most would tell you this is something that is probably going to be pushed through, but it won't be the kind of thing that's so I mean, there may be some room to kind of toggle at the margin. If you're talking about 30, 40, 50%, for some products at least, some things that are closer to commodities, commodities are a low margin business, then you are going to be dealing with pretty meaningful price increases for the consumer. There are the knock-on effects to exporters that I still do worry about. America still exports a lot of stuff. Yes, we do. We're not as trade-oriented an economy relative to some other ones because we're bigger, and so we're more closed. But we still export a lot of products and a lot of products.
Yes, we are a $29 trillion economy, and even some small fraction of that is large.
Yeah, some small fraction that is large, but also you think about like aerospace, right? You think about the different machinery products we produce in terms of tractors, construction, for agriculture. There's still a lot of stuff we export, and turbines, right? There's still a lot of demand for turbines. We produce a lot of that stuff, so that does affect a set of some companies. And I would say that becomes a bigger target of retaliation, potentially. There's a lot of ways in which our financial markets obviously become more internationalized, and so that's something that also becomes a potential area to be thinking about how retaliatory measures might be structured. All of these things feel like they're coming a little bit off the boil because the administration has moved in a much more conciliatory direction very quickly. But that is like another cost. It's why messing around with trade policy is somewhat perilous, because there are a lot of these other knock-on consequences. Yes, the consumer and the business pay some share of it, but there are all these other collateral consequences that may also emerge. Supply chain quirks that end up mattering a lot more than you realized. Or else, like, you have a lot of retaliatory measures that undermine your industries that you actually value.
Well, you mentioned the United States exports a lot. I just got an idea. We export a lot in podcasts also, because I just looked, Sonu. Our podcast has now hit 81 different countries, which is pretty cool. Okay. United States has been 84% of downloads. Sonu, take a guess. Which country has the second most downloads of this podcast since we started doing this 136 episodes ago?
It's probably some random country. I was going to say
I'm shaking my head.
Canada.
Yeah.
Canada.
It's Canada. Canada's 5%.
Because you're always on BNN Canada.
Yeah, I'm big in Canada. Canada, 84% US, 5% Canada, 2% UK, and then that's it. Then everybody else is technically zero, because I guess it rounds down to zero. So thanks to Canada, UK, and then the other 78 countries that listen to us. All right, Skanda, we're getting close to the end. I like doing a big picture one. I like to ask this a lot. You probably talked about it last time, but I love talking about careers. Obviously, you started your own company, right? I mean, and you've been a very successful business owner. But talk a little bit about the trials, tribulations to getting to where you are now. Some things you learned, some mentors, everyone to take this, but just something for, the advisors out there listening, the small business owners listening, some things you've learned over the years or decades, maybe.
And if somebody wants to get into macro, like what would they,
Oh, you can talk all day on this one. Yeah.
I'll just say, I think, so I got interested in macroeconomics when I was late in high school, when the housing bubble was popping. So it was getting interesting, and it was like in a moment of also the blogosphere was sort of in its infancy, I think, still, or at least you could find a lot of great content for free that was a lot better than what you could find in a textbook. And that interest and passion kind of just drove me from there, where it was. I went to college and studied economics and applied math. Got to work at the Fed for a bit. Got to work at a hedge fund, and that's all stuff that's obviously I try to follow things that are relevant to me because I was really interested in this stuff, and I do think the interest kind of helps overcome there's also all sorts of obstacles for everyone in their careers. But if you have some core interests, and a core interest does not mean a core job, right? We can all do very different jobs in our careers over time, but I do think it gives you some grounding if you really have a real interest in whatever you're doing. If that's for me, it's macroeconomics and the macro. When I say macroeconomics, I'm talking about business cycle macro, financial market relevant macro, the data sets. The other part of it is I think it's letting the information guide you and not trying to have you think that you know the answer and then can just find the information to back you up. That's those are probably some things that just have served me well in a lot of different places. It's helped me stay open-minded, helped me find new opportunities. Those things I think have really stuck with me in terms of just being able to drive forward. As far as the specific career, I'm too young in my career to give too much hard career advice. Everyone's navigating their way forward, and I'm sure there will be more challenges ahead. But I think at least as far as finding what you really can do in the hard moments when things aren't, like what really like keeps you motivated is going to kind of guide everything else very much more easily than if you don't have that kind of focus.
One more quick one. I heard the Fed. That's interesting. Was it under Bernanke? Was it under Yellen? Who was in charge of the Fed when you worked there?
So this is the New York Fed.
New York Fed. Okay.
From 2013 to 2015.
Okay.
And so that was a period of Bernanke and Yellen.
Yeah, you got them both. Okay. Did you get to meet either of them? Have you spoke like face to face or? Yeah.
I didn't get to meet either of them there.
Okay.
I did get to meet Bill Dudley, who was the New York Fed president at that time.
Yep.
And it was at a time when the institution was had just kind of coming out of the financial crisis, right? So they had done all these all that stuff had been.
They were in the thick of it.
Yeah. Yes. What a time to be there.
And you got to say, hey, this is the place where Dick Fuld came to try and negotiate a deal with Tim Beckner, and this is the place where. So there's a lot of that kind of history, and there's a lot of hey, we do all this stuff now, and we track all this data that we used to previously not track because we ran all these facilities, and so the New York Fed just was this kind of focal point and locus where you could. There's a lot of people doing really interesting research and analysis, and they're trying to figure out how we're going to raise interest rates with this big balance sheet. And there was all these kinds of questions that are just very intellectually interesting. And I learned a lot of skills and tools and just how to think. I think that's probably the biggest thing from that experience.
I want to talk about the Fed, but really quick on your career, what led you to do the JD and get into law? Because, between law and macroeconomics, what's the connection there?
So we do a lot. Part of my organization is also about a lot of policy analysis, right? So we think about what policies are on the table and what policies are actually going to be able to be pursued. There's a lot of assumption that you can just do whatever you want when you're in government, or you just say government can't do any of it. And it's really law and regulation are kind of ultimately decide what's feasible, right? You can have hey, we should do this policy. This is the best policy. Yeah, but do you have any authority to do it? Yeah, does the Constitution allow you to do it? You have to kind of answer those questions at some point if you kind of believe in this stuff, right? And I do think that's a part of and I think everyone on some level does to varying degrees.
Sure.
But it is important to be able to say here's with the authorities you have with the this is and with the processes that are on the table that you have to follow, here's where your optionality exists. Here's what policies you could do. If you want to try and use a strategic petroleum reserve more creatively to support oil production.
U.S. shale, yeah.
Mm-hmm.
Yeah. What can you do? What's actually available? Or are you just going to say things and then not actually do anything? So it shows up in a lot of those ways, and policy ends up mattering for macro, right? Policy ends up
absolutely. Yeah.
So if a policy, it can be good, bad, whatever, but if you're trying to figure out how to manage a lot of difficult shocks, or if policy is inflicting certain shocks, it's important that then that type of analysis ends up overlapping quite a bit with sort of legal analysis.
How many employees do you have?
We're very small.
Okay, right. Okay.
We're about 6.5 people. Yeah, 6 to 7. Yeah.
Who counts as 1.5? Are you 1.5? Teasing. We all do a lot.
So, speaking of policy, let's just start here. Should the Fed have cut rates back in January and March, given the inflation outlook and given the fact that the heat was coming from lagging areas like shelter inflation and maybe auto insurance, things like that? Should they have cut in January and March? And now it seems like they're in a bit of a pickle.
I'm not sure they're in that big of a pickle. I think at this point, it's if the economy is as strong as financial markets are kind of implying right now,
right?
It doesn't make a really strong case for saying they had to go in Jan or they had to in March.
Sure.
I think that what has spooked the Fed is the tariffs, right? Let's be blunt about it. It is that there are enough Fed officials. I don't even think Jay Powell is the most spooked by it, but I think you can definitely get a drumbeat of this from the regional Federal Reserve presidents. The presidents of those regional Fed banks are all basically saying, my contacts tell me there's real price risk here. And I think unless everyone can understand that, hey, prices might go up and then not be related to monetary policy, and two, might be something worth looking through. Unless like everyone's on board with that, like understanding, you look like a fool if you're like cutting rates right before inflation explodes and the economy hasn't collapsed, right? Like that, I think is the. So if you like cut rates, inflation rose, the labor market stayed intact, you kind of have like no leg to stand on, and so then people just say you don't know what you're doing, and then like why do we even need to have this institution in the first place? You start getting quickly into existential questions if you do stuff like that. And I think there's like a risk of that at this moment, especially where like you're seeing signs of like, hey, growth's quite resilient. We're going to do these big tax cuts. That might be something that's very supportive of growth. That might be risking some inflation, and also at the same time, tariffs might be not as big as we thought. There's probably a little bit of inflation associated with them. Is the Fed supposed to be cutting rates in that environment? I think that's a really hard sell to make in March. I think I could have made a better case for you if like some of these policies weren't on the table. If they are, the Fed's just going to be a little prudent around those risks. It's like they don't want to be dealing with another inflation episode if they can afford to. So they could end up in a pickle later this year, especially if like the tariff effects end up being bad for growth and bad for inflation. Very real possibility of that. Mm-hmm. But we'll kind of have to see as we get there. Right now, it doesn't yet scream that outcome right now, at least.
So I think, Sonu, we probably have time for about one more. I'm sure you are thinking what you want to ask here, Sonu. What do you want to ask Skanda on our potentially final question of facts versus feelings this week?
You know what? I'll go in the direction of you wrote a recent piece about energy prices, which I thought was very interesting.
That was my money was on you asking this. I got it right. I didn't want to say it.
I was going to talk about inflation targeting, like set that aside, right? But you guys wrote a great piece on that. We linked to that. But I just wrote a blog yesterday. I linked to your piece on, energy price volatility, especially, and this gets to policy too. You just talked about policy and, how U.S. households could be susceptible to energy price shocks around the world because of policy. Talk about that.
Yeah, so I'm going to guess that you guys, just like me, are facing higher electricity bills now, right?
My wife pays them, so I don't know. Not yet, but yeah.
But relative to what you would have seen maybe a few years ago.
I'll just chime in real fast. My water bill was up a lot, and it's because we've got a running toilet in my kid's bathroom. I think they don't even realize it. I think the other day I walked in. Who knows how long that was running? So I think that's why my water bill this month was up a ton. But anyway, that's more mistake on our behalf. But yeah, energy is a little more expensive, no doubt.
Yeah. But electricity.
Apologies. Electricity. That's what I meant to say.
Electricity prices are generally up across the country. Different degrees in different places, depending on the mix of generation. But you tend to see that natural gas prices in the U.S. tend to drive electricity prices, which makes sense because natural gas is still like the linchpin for most parts of the country. And yet, natural gas prices, like we have a wealth of resources for natural gas in the United States. Not running out of natural gas anytime soon. But we have unlocked the ability to export natural gas. And it turns out the rest of the world, natural gas isn't so cheap. And so if you're thinking about whether to produce for the domestic economy or another country, you go to the highest bidder. The highest bidder is abroad in a lot of cases. That tends to pull up on natural gas prices. The downstream effect of that is Americans are going to pay higher electricity, and we call it utility gas service. These are things that will be upwardly strained. There are a lot of ways to navigate that. I don't think the answer is, hey, let's lock in all the natural gas in the United States and basically screw the producers. I don't think that's a prudent policy in any way. But if you're going to do that, you probably need to diversify how you get your electricity. There are certain parts of the country where we rely on, like, hydroelectricity or nuclear, where this effect is much more mitigated. And so if you want that kind of diversified energy system, it'd be wise to think about, like, whether if you want to avoid natural gas prices spiking your utility and electricity bills, you'd like to see a more diversified energy system. It's really, and especially when you think about like the way in which natural gas prices are getting kind of spiked at various points. We had a much more exaggerated version of this in 2022, when typically speaking in 2010s, natural gas prices were about $2 per million of BTU, versus thermal unit. And they went up to $9 in 2022. And so 2022 they spiked and that was because hey, we were exporting all this natural gas to Europe, who didn't get as much as they could because
Russia had the war. Yeah.
Because the Russian war broke out. And then they kind of came back down, but even then, they're not going back to the 2010s level of $2 on a sustained basis. And we quickly see these spikes now show up that were not showing up in the 2010s. So we saw this from September to March, we went from something a little over $2 all the way past $4. And so these things have still have meaningful necessities for what Americans are paying for utility, gas, and electricity. And so because of that, it's probably wise to find ways to rotate that, right? Find ways to kind of be able to, if you want to address inflation, like this is something the Fed tries to look through this because energy, but it nevertheless matters, right? And so especially when you think about consumer spending and how do you make sure like it's not being crunched by a lot of these types of price shocks, you should think about like what are the ways in which different parts of the energy system could help. If natural gas prices spike, it doesn't have to mean that you have to pay more for electricity and energy services, but that means you need a more diversified system, and that means you need to think about that stuff a little more proactively.
And tying it to policy, it seems like, and this who knows where the tax bill will end up, but it seems like they're gutting parts of the IRA, the Inflation Reduction Act, which also means, again, this could be rumors. Like stuff is going to change when it goes from the House to the Senate, but it looks like nuclear is also going to suffer as part of this. And speaking as somebody in Illinois, we get 50% of our power from nuclear, right? I imagine a lot of the country could benefit from something like that, but not if you got it.
Yeah, it's one of those things where nuclear is a good example of where you don't plan for the moments when you really could benefit from nuclear, but once they happen, you're really grateful for it. So like 2020, if you're like in a nuclear-oriented state. So yeah, if you're in Illinois is a good example. I should have not asked you actually that question. You guys probably are in some of the better positions in most of the country. If you're in Georgia, you probably like that. There were a lot of problems with how they built that nuclear there, but it was pretty handy in 2022 when natural gas prices spiked and you didn't have to rely on it at all. And so these are like things where you got to do a little bit of forward thinking, and some of the investments that are probably not super attractive to the private sector, you got to think about how to make them attractive to the private sector, because they just help give you optionality and some level of diversification in the really not so nice moments when there's either geopolitical shock. That's kind of that's where that stuff is most useful. And so those policies are on the table right now in terms of maybe cutting back the support for nuclear, cutting back some of the support for those other sectors. The other side of it is, there's like other things the tax bill obviously is going to try and promote in terms of manufacturing, production. We'll see how that stuff shakes out. Like you said, there's still a long ways to go in terms of what gets put in the tax bill and what we can make sense of it. There's still negotiations going on. Right.
Very, very interesting there. Skanda, how about end it with one more time where people can learn a little bit more about you, learn a little bit more about Employ America.
So you can learn more about Employ America at employamerica.org. If you are interested in our data products and services in terms of data and analysis, it's called Macro Suite. And you can find that on our website as well. So employamerica.org. And we're happy to walk anyone who's interested through what we provide in terms of deep dive, granular data analysis.
All right. That was great. Well, again, this was episode. Thank you, Skanda. We're big fans. Thank you for everything you do for the industry and so many investors and macro thinkers out there. The stuff you guys do. Again, you're not just following the crowd. All the sell side might be saying one thing. You might say that if the data says it, but if it doesn't, you're willing to take a stand against what everyone else is saying. I think it's something that we respect a lot, and continued success. With all that, again, this is episode 136 of Carson's Facts versus Feelings. We'll be with Dan Ives next week. Hope everyone enjoyed this and learned a lot. We'll see everybody next time. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.